afternoon, everyone, and thank you for joining us on the earnings call of Astec Lifesciences for the quarter 4 and full year FY21. We have with us today Mr. Nadir Godrej, Chairman of Godrej Agrovet and Astec Lifesciences. From Godrej Agrovet, we have with us Mr. Balram S. Yadav, Managing Director, and Mr. S. Varadaraj, Chief Financial Officer. From Astec Lifesciences, we have Mr. Ashok Hirmat, Managing Director, and Mr. Arijit Mukherjee, Chief Operating Officer for the company. We would like to begin the call with a brief opening remarks from the management, following which we will have the forum open for an interactive Q&A session. Before we start, we would like to point out that some statements made in today's call may be forward-looking in nature, and actual results may differ from those expressed or implied. Would now like to hand over to Mr. Nadir Godrej for his initial remarks. Mr. Godrej.
Good afternoon, everyone. I welcome you to the earnings call of Astec Lifesciences. I hope and wish you are doing well and are staying safe. In the financial year 2020-21, demand and supply was disrupted across sectors due to the COVID-led lockdown. As a result, the output for most sectors is expected to be lower than the previous year. However, the agrochemical sector was classified under essential commodities. Therefore, agrochemical companies, including Astec, have not been materially impacted. In the beginning of the financial year 21-22, India is seeing the second wave of COVID-19, which is more severe. But the situation is expected to normalize in coming months as the rollout of the vaccination program gathers traction. Economists expect India's GDP to grow by double digits, driven by the expectation of higher consumption, investment, and a revival of the service sector. The agricultural sector is again expected to grow as early macro indicators look promising, with the expectation of a normal monsoon. This will benefit farmers and companies catering to this sector. Now, I will quickly take you through the financial performance and key developments of the company during the fourth quarter and the full year ended March 2021. In quarter 4 fiscal year 21, Astec had reported consolidated total income of 174 crore compared to 186 crore in the same period in the previous year. EBITDA and PBT during the quarter were 40 crore and 32 crore respectively, as compared to 48 crore and 40 crore respectively in the same period last year. For the full year 2021, total income was 563 crore compared to 534 crore in the previous year. EBITDA and PBT were 119 crore and 89 crore respectively, compared to 97 crore and 61 crore in the previous year. We would like to highlight that due to the seasonality involved in our business, full year financials are a better representative of our performance. In the fourth quarter, revenues were marginally lower than the previous year due to a high base effect. However, for the full year, revenues have grown at 6.3%. Geographically, revenue growth is driven by the domestic business, and segment-wise, enterprise sales have contributed to growth. Given the higher demand and better pricing of key products in India, Astec focused more on the domestic market than exports. While export volumes have also grown, low pricing over the high base of last year has impacted export revenues. The gross profit margin for the year has increased to 39.2% from 36.7% in the previous year, driven by higher volumes, better pricing, and strategic raw material stocking. The EBITDA margin has increased to 21.2% from 18.2%, and profit before tax has seen robust growth of 45.2% year on year. Our balance sheet remains strong with a debt-equity ratio of 0.6 as on March 31st, 2021. Return on capital employed has increased to 22.3% for this year compared to 20.4% in the previous year. We have successfully developed and launched a new contract manufacturing product for an international client in fiscal year 21, and this, coupled with commissioning of the herbicide plant, is expected to contribute to revenue growth in the near term. We are also in the process of constructing our new state-of-the-art research and development facility, which is expected to materially increase our capabilities to take up new projects. The agrochemical sector is more resilient vis-a-vis other sectors to the disruption caused by COVID-19. Further, macro indicators for the sector are expected to be positive in fiscal year 2022 as well, both in the domestic markets and international markets. At Astec, we believe that given our future plans, we are well placed to capitalize on the growing opportunity. That concludes our business and financial performance update for the quarter and for the year. With this, I close my opening remarks. We will be now happy to take your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harish Kothari from Alpha Accurate Advisors. Please go ahead.
Hi, this is Rajesh Kothari here. My question is to Mr. Godrej. In terms of a few years back, you were contemplating a merger between Godrej Agrovet and Astec Life. What are your plans now? What is your thought process? Considering that Astec Life has now become a really very solid company and also the future looks very bright, do you still consider the merger or it will remain as an independent entity?
We are always looking at that option, but we don't see any prospects in the immediate future.
Any rationale for, since it is not yet clear, why it is, why such a thought of, merger? Why not to keep it as an independent entity?
In the long run, I think it would be best for us to merge this business, since we also have an agrochemical business, but I'm not sure this is the right time.
Oh, I see. Fine. Sir, my second question is with reference to the business, last time you were saying that, the capex is coming on stream. So whether that the plant has started and how do you see the utilization in year 1, year 2?
Yes. Would anyone else like to answer this question?
Mr. Ashok can take it.
Yeah, okay, I'll take this. The new herbicide plant that we spoke about, it got delayed a little bit because of the COVID situation. But however, I'm happy to tell you that the plant is ready. We're just waiting for some permissions to come in. And again, because of COVID, government offices are taking some time to grant all the permissions. But we hope to have it commissioned by the end of May or early June. In terms of the first year of operation, this year we expect the utilization to be in the range of 25-30%. But we intend to fully utilize it by year 3. That will be the phase-wise ramp up in the capacity utilization of this plant.
Okay. Thank you, sir.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Yes, sir. Some color if you could give on the volume and pricing growth that we would have recorded in FY21. And in your initial comment, you mentioned that exports had not done well because of lower prices. So if you could comment on the extent of pricing decline in any of your key product portfolio, if you could, that would help us give a better color on your top line numbers.
Yeah, I think it's since we have many products, it's hard to tell you about each product's decline and increase and so on and so forth. But to answer your question, although our top line went up by 6%, our volume growth was 12%. So that gives you a kind of a flavor of what was the price declines. that led to lower revenue growth than our volume growth. But having said that, we controlled our costs very well, and therefore we improved our margins. You can see that our gross margins improved by 3% this year, which effectively led us to a higher profit before tax. The domestic market was particularly strong, and it's not that the export market was not good, but we deliberately made a choice to sell more in the domestic market to maximize our margins.
And any color on what would be the domestic growth and what should be the export growth first?
The export as a percentage of sales declined from about 54% to about 48% for the last year.
Okay.
Now, in terms of growth of exports, Arijit, do you have this number? We have export growth was minus 8%, and the domestic growth was 25%.
Okay. But Ashok, there was no volume decline in exports, was there?
No, there was only marginal decline in the export volume because of the significant improvement in the domestic sales. But overall, as I said, there was a 12% increase in volume.
Okay. So I'll just read it. I'm just confirming it. Export declined 8% by value and domestic grew 25% by value in FY21, right?
Correct, yeah.
Okay. So this explains the correlation with the pricing decline of 6% that you would have seen, which is largely the export market.
Mm-hmm. Yes.
Okay. Another update I wanted, we were supposed to launch a couple of products in the export. One was, I think we got some business on Teconazole. That was the product to be added. So, what is the status there in terms of business? And should we see? And your last year's annual report also talked about 2 new products being added. So, when should the business for those 2-3 products flow in?
Yeah, well, those products you spoke about were well accepted by the customer. Now we see that there's going to be regular demand for these products. So we introduced the triazole that you spoke about. We introduced another intermediate for a herbicide, which is expected to have very, very good sales growth because it is a patented molecule that is it's being made for. It's a herbicide that's been introduced for the first time this year. And it is competing in a market space which has got a very high volume potential. So over the years, we expect that to be a very large molecule for us. Basically, last year we introduced 3 new molecules. This year we plan to introduce 4 new molecules, 2 in the CMO space and 2 in the enterprise sale category.
Okay. So both will be linked to exports, right?
Sorry?
Both will be linked to exports.
Most of the contract manufacturing is also exports, and one of the enterprise sale products is for the domestic market, but eventually we'll start exporting it, but initially for the local market.
And Teconazole sales have started last year.
Yes, correct.
Okay. Thank you. If I have more questions, I'll come back. Thank you.
Thank you. The next question is from the line of Abhijit Akela from IIFL Securities. Please go ahead.
Yeah, good afternoon. Thank you for taking my questions. Just to understand the improvement in margins this quarter, on a sequential basis, gross margins are up, EBITDA margins are up even more sharply. So what's helped there? And, even on a year-on-year basis, despite very difficult comparison from last year, when I believe prices of one of our key products were very high, we still performed quite well this quarter in terms of holding up against the high base. So, any particular factors that kind of helped shore up the performance this quarter?
Yeah, that's the beauty of our business, because we are multi-product. That if one product is having a slightly lower margin, we can make it up with something else. One of our other products, which had a lower margin last year, gave us a much better margin this year. There was a shortage of it, and we still continue to see very strong demand for that product in the coming year. So, given our product mix, something makes up for a decline in certain products, and that was the effect of that. Another product did very well this year.
Okay, so for coming quarters, should we expect this level of margins to sustain?
Yeah, we don't see any reason for any decline on our margins. As I said, always given guidance, we expect our EBITDA to be above 20% going forward. So we are always working towards ensuring that our product mix is such that, and then the backward integration that we do, and the strategic procurement that we do, and everything else, make sure that we maintain our margins.
Right, got it. Thank you. That's helpful. On the herbicide plant that's about to be commissioned, you mentioned about 25% utilization for this year. So just wondering if you could help us with, any. First of all, I mean, what segments is it targeted at? Is it mainly for enterprise sales or CMO or both? And any rough split you could give us. And second, any orders in hand that we already have for that plant?
Yeah, it's a plant that was built for a CMO customer. It's just that in the first year the utilization will be less, but since after the first campaign is over, we will then make another product which is also on contract for a customer. So there are two products on CMO basis which will come out of that plant, and the third product which we will make over there will be an enterprise sale product, which we'll produce towards the latter half of the year. So I would say revenue-wise about 50-50 for enterprise and CMO.
Okay, got it. Got it. And the CMO part is already tied up with firm orders in hand?
Yeah. So firm orders in hand, yeah. And these are all things that have a long-term potential demand. Right,
sure. And one last thing from my end, and I'll step back in the queue. Just an update on, your new personnel hiring plans. Any further key functions that you've kind of beefed up with addition of new talent from outside. And second, just on the R&D center, when should we expect it to be commissioned?
In terms of key personnel at a senior level, we hired some people in R&D, and also at the middle level, most of the beefing up has been in R&D and technology transfer. We see that as we are introducing more and more products, we need a very smooth way that we scale up products from laboratory to pilot plant to plant. And we've demonstrated that this process that we started following gives us very good results, because we are able to get our desired quality, yield, costs in the shortest possible time. So in order to improve our ability to introduce multiple products, we're hiring more and more people in multiple tech transfer teams. So that's the effort on the people recruitment. In terms of the R&D, there's been a little delay in the construction of that because of COVID and some design changes that we did to improve the R&D center. So we are expecting now that the completion will be Q2 of next year.
That's Q2 of FY22. So yes. September, basically, we're saying September 20.
July, August of 22.
Oh, July, August 20. Okay, yeah, got it. Thank you so much. I'll step back in the queue.
Thank you. The next question is from the line of Susmit Patodia from Motilal Oswal. Please go ahead.
Hi, good afternoon, sir. Hope everyone is safe and the Astec family. My first question is, this is only the second time that your operating cash flow is negative in your history. Any thoughts on that? What happened? You seem to have paid down a large part of the payables. is this? If you can just throw some light on it, please.
Okay. Can I bring in my CFO, Saurabh Bhala, to answer this question?
Sure.
Yes. Saurabh, can you take this question, please?
Yeah, sure. So our cash flow is a very slightly negative, basically on two count. This year, our working capital position in the Q4 has increased a bit. Primarily, as Mr. Ashok was explaining, we have more of domestic sale than export sale. Last year, we had done a lot of export factoring in Q4 for most of our export sales. This year, the domestic sales being higher, that possibility was not there. So that is one of the key reasons why our working capital went up. Along with the other reason, this year the strategic stocking level was low, and accordingly our creditor levels were slightly lower. So this has contributed in the overall working capital going up marginally, and accordingly the operating slightly negative operating cash flows for the year.
And is this a one-off, or if domestic continues to be a larger proportion, this is something that will play through?
It depends on the profitability. As Mr. Ashok has already explained, wherever we get better margins to improve the profitability of the business, we will try to take the advantage. And as of now, the margins are domestic remains to be healthy. So depending on how the export and domestic dynamics play on, to protect our margin, we will take the calls accordingly.
I would like to point out that interest rates are very low, so this is not a cause for concern.
Absolutely.
Mr. Nadir, it is your group's philosophy that revenue is vanity, profit is sanity, and cash is reality.
Yes. But we won't sacrifice profits to have cash.
Right. But there is, okay, as shareholders, I would just like to submit that to have profits
there is no concern on
cash.
that at all. We are in a very healthy position overall. And as Mr. Godrej also said, the borrowing remains to be very healthy and interest rates are going down. So we are in a pretty comfortable position. Nothing to worry about.
Right. I would like to add that you might have noticed that our interest cost last year was less than 1% of sales. So our average borrowing during the year was only 102 crores. It is in the last quarter of the year because of our increased domestic sales that the borrowing went up as of the year end. But if you look at our average borrowing during the year, it was only 102 crores. And while we had a capital investment last year of about 130 crores, we managed to have that level of borrowing throughout the year. So which indicates a very strong level of internal cash generation. And this level of higher working capital which we have at the end of the year will be reduced in the first quarter of this year because those receivables will start being collected.
Got it. All right. And my second question is the CWIP that shows up of 110 crores. This is pertaining to the herbicide plant that is still to be commissioned?
Correct. That the moment it's commissioned, we will then capitalize it.
Right. So just on the herbicide plant, Ashokji, if I may ask, on 27 Jan call, you had indicated that the plant will be inaugurated in the third week of February, right? And obviously COVID then struck. So this delay is because of COVID, or is there some stabilization challenges?
No, actually some permission got delayed. Unfortunately, we were expecting some permission. The plant was ready. In fact, we even did an opening of the plant.
Okay.
But unfortunately, there was some permissions didn't come through, and then we were waiting for them, and there was they got delayed. Then COVID happened, and the people were not coming to the office, and so on and so forth. That was the only reason. Otherwise, the plant was ready.
Got it. All right. That's all. I'll get back in the queue. Thank you, and best of luck. Thank you.
Thank you. The next question is from the line of Swacha Jain from ANS Wealth. Please go ahead.
Hi, sir. Thank you for giving this opportunity. Sir, I just have a couple of questions on the numbers. If I look at the P&L, employee cost has gone up, while our finance cost for this full year has significantly gone down. So if you could just give a guidance as to, how do we see these employee costs and interest expense, going ahead over the next 1-2 years? Do we take this as a new base?
Okay. Again, you can take that.
I will take that, sir. So in the current year, employee cost has gone up basically on two counts, which are not normal. So this year, as you know, our plant got operational right from April, and all the employees and the labor went out of the way to support the operation. And accordingly, company also supported our team in the exceptional time by giving some extra hardship allowances to maintain their safety and to motivate them to work during those times. So that was one source expense during this year, amounting to roughly about 2.5 crores, which is not normal. That will obviously come down once the COVID situation is normal. And other increases are basically new headcount increase, which is happening for the plant and R&D and our regular operation. Those are the two major reasons. So one will get normalized and other thing will continue, because as our operation base keeps on going up, we add new plants, the employee strength keeps on going up.
Yes. But Arijit, I presume our employee cost as a percentage of sales is not rising.
Right. Yeah. So in absolute terms, we might see a little bit of increase in the expense just because, as per the business need, but nothing one-off that we are expecting next year, right? I mean, going forward.
Not really.
Godrej, can I add something here?
Yes.
We are recruiting ahead of time in R&D, sir.
Right. Yeah, absolutely.
Okay.
And again, to add to that, our employee cost is around 7% of sales, which is a healthy level. And some, when we hire like this, and revenues, catch up, and again, it'll kind of normalize at that level.
Yeah.
Right. Okay. And so also, if I look at, the second part of that question was the finance cost. If you could just share your views on it.
Saurabh, please go ahead.
Finance cost, so basically as soon as COVID hit, we did a lot of restructuring of the way we were borrowing in terms of instrument, and we renegotiated the rates with the banks. As you know, this year has been a reducing interest trend, and we took the maximum opportunity out of it. So our borrowing cost for all the short-term loans went down drastically, and this year we were also issued commercial paper in a bigger way at a much better cost. So these two are the major reason why we were able to get our cost overall down.
Right. So and we do see this interest cost being at this level or going down from here in next year?
Since the COVID phase 2 has already hit us, I don't think it will immediately rise. So H1 should remain at the same level. H2 depends on how the COVID situation improves and what are the RBI monetary policies. Probably H2 it may have some impact, but as of now we are pretty much in comfortable position in the similar way.
Okay.
But current interest rates are so low that even small increases will have no impact on us.
No major impact, sir. That is true. We don't foresee any major increase in our borrowing interest cost for the current year as well.
Right, sir. So my second question was, in the other expenses, we have a one-off of 6 crores. So I just wanted to understand, is the entire magnitude being taken into consideration, like 6 crores, or are we expecting all this 10% or 20% of what we've currently taken in other expense?
No, other expense or other income, we are talking about what?
Other expenses. If I look at the note, I think in other expense, we have taken an impact of 6.2 crores as an error of export incentives claimed in earlier years. So I think we've taken that.
That was last year, and that was one-time adjustment.
Right.
And no further such adjustment is foreseen in the years to come.
Okay. And so just my last question, if I can take this up. If I look at the current assets, other current assets have also...
sorry to interrupt, ma'am. This is the operator. I would request you to rejoin the queue for follow-up questions.
Sure. I'll do that. Thank you.
Thank you. The next question is from the line of Shravan Vora, an individual investor. Please go ahead.
Hello.
Yeah, please go ahead.
Hello.
Yeah, hi. Thanks for the opportunity. I hope all is well with our team at Astec. So, sir, I just had one feedback. If now we are a 2,000 crore market cap plus company, if we could have a more detailed presentation on our growth prospects like our parent company, Godrej Agrovet has. That was one feedback on my part.
And I just wanted some color in terms of growth for the company in the medium term to long term, say 3 to 5 years. Break up, if you could give, from the traditional enterprise sales and CDMO business, and what kind of growth can we see in terms of sales from the herbicide business? Just some color on that.
Firstly, the guidance that we've been giving all along is that we see a compounded profit growth of 20%, and we've been delivering on that and perhaps over-delivering on that. The revenue growth will depend on pricing and so on and so forth, but the bottom line growth is we expect this to be the kind of trend of growth. In terms of the CMO versus this, while we have a number of CMO projects in hand, our domestic sales are also, our enterprise sales are also growing simultaneously. So while we want to increase the kind of proportion of CMO sales, we are seeing that it is in the range of 20% for a few years. So while we had ambitious plans earlier, we would at least try and bring it up to 30% in the next 3 years, and then see how it goes after that. But once this new R&D facility is there, we hope to land some pretty big projects, and then that whole scenario can change. In terms of your question about the herbicide plant, well, we've invested about 100 crores. We expected a kind of a turnover asset ratio of about 1.8. So by year 3, that's the kind of turnover we expected out of that unit.
Right. Perfect. So I got your point, and all the best. Thank you so much.
Thank you.
Thank you. The next question is from the line of Harish Bihani from ICICI Prudential Asset Management Company. Please go ahead.
Yeah, hi, good afternoon. Hello?
Good afternoon.
Good afternoon.
Okay. Sir, first is on the R&D.
This is the operator. There is a slight airy disturbance coming from your line, Mr. Bihani.
I hope this is better now. First question is on the R&D. If I understood correctly, the R&D center will be commissioned next year, sometime mid of next year. In the meanwhile, how should one think about the entire progress of the entire R&D that you are doing in terms of the product, the effort that you're doing in right now? That's one. In terms of the number of people that you have at this point in time, how will this kind of ramp up post the R&D center commissioning?
Well, at the moment we have hired some additional laboratories near our existing laboratory, which has increased our kind of capacity for development significantly. So that is how we are tiding over this time until the new R&D center comes. In terms of the number of people in R&D, Arijit, can you help me with that?
There are around 60 people directly from synthesis to the piloting. So more or less there are 60 people who are working in the R&D.
And what will the step jump like post the R&D center commissioning, or is it going to be a gradual kind of an increase?
No, there will be a gradual increase. So based on the requirement of the projects and everything, there will be a gradual increase. With the required skill set, we will gradually increase it. But before the new R&D comes up, we will employ some more people. So that is a continuous process of adding up. Few more people that will go on across the year.
Sure, Ajit. And in terms of the effort that you're putting in now for the next 1 year or so, how should we think about in terms of these yielding efforts, final fruits? This will happen in 23, 24. How should we think about the timelines?
Difficult to answer.
And I'll just take that one. In terms of being able to develop the products which we have in the pipeline, we're able to cope with that. We're completing the development work as and when we are needing to commission the products. As I said, this year we got 4 products coming online. We have the products developed. We will do all the safety, whatever studies and scale-up studies that we need. We will be able to cope with all that. It's just that we want to accelerate that further with the new R&D center.
And any one particular area of focus at this point in time?
You're talking about right now or until the
right now,
R&D center?
For the next 1 year, one and a half, 2 years?
Well, as I said, we have 2 CMO products right now we want to introduce this year. We have another 2 CMOs that need to be commissioned in the following year. We have 3 enterprise sales products to bring out in the next 2 years. We have at least 4 or 5 backward integration projects.
Sure. In terms of, so when we look at Astec, apart from some of the key management personnel which is mentioned in the annual report and we get it online, can you help share, say, about 4 or 5 key people in the company at this point in time, and what are the things that are being shared between Godrej Agrovet and Astec at this point in time?
What do you mean by you tell us about key people mean? I don't understand the question.
Apart from the Chief Operating Officer and MD, so these are clearly mentioned either in the annual report or we have been interacting. But apart from that, in case you just go and do a random search in any particular website, etc., you don't get much. So essentially what we wanted to understand is, they say, who's leading the sales effort, who's leading the other efforts in the company, apart from R&D, whom we kind of understood you've hired recently.
It's a normal organization structure, there's the head of all manufacturing, there is head of technical services, there is head of quality control. I mean, there is.
Are these all? So essentially, sir, what we are trying to understand is, are these all long-standing employees in the company, or some of these are recent hires similar to what you have done on the R&D side?
No, most of these people are long-standing people. They've been around for at least 10 years.
Sure.
Yeah.
And lastly, intuitively, when you think about Godrej Agrovet and Astec Lifesciences, intuitively, to us, it seems that both remaining separate makes sense. However, we are happy to engage in a separate conversation because Godrej Agrovet, again, has a lot of moving parts versus Astec, which is much simpler at this point in time. So merging these from a minority shareholder interest might not make much sense. So just thought that maybe we can have a detailed conversation later on this particular topic. Thanks.
Thank you. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, would request you to rejoin the queue. The next question is from the line of Aman Vij from Astute Investment Management. Please go ahead.
Good afternoon, sir. My first question is on the what was the growth in the CDMO/CRAMS business for FY21?
Actually, there was a bit of a decline in CRAMS business last year because of one major product of ours. The customer had some inventory, and so they did not order as much as they did the year before. So our decline of CRAMS was 6.8% last year. But we're going to make it up with new products this year. And then when that product comes back in the inventory, they run through the inventory, then again this will be back on track. So it is a slightly temporary situation.
Sure, sir. And on the domestic and export trends, like we saw in FY21, where exports had some headwinds because of pricing, do you think for FY22 also domestic will be the major growth driver?
Well, I think it's hard to predict that. It's all, the agrochemical business is based on weather conditions all over the world, where the demand is strong, where there's dry conditions. Last year Europe had very dry conditions. So therefore the fungal attack was less, and therefore the demand in Europe was less. It all depends on the particular season, so we'll have to see how it goes.
Yeah, and the important point is we are a flexible organization. We can switch from one to the other, and capacity utilization is usually high even though we keep expanding.
Yes, sir. So I was asking in terms of supply, in terms of pricing of our top 2-3 products. So one product, the prices had fallen drastically while one had improved. So for the first 1-2 months, are you seeing the same trend, or the prices also keep fluctuating?
No, the one that had gone down is now at that level. The one that had gone up is about that level. In fact, It's gone up. The one that went up has gone up further. So, we have to see the blended average effect of all this.
Yeah, and often, even if the prices change, the margins are maintained because costs come down or other factors are there.
Yes,
correct.
Thank you.
That's the important thing. We always, whichever way around, we focus more on the margins.
Sure, thank you.
Thank you. The next question is from the line of Saurabh from Asian Market Securities. Please go ahead.
Thank you for the opportunity. So just wanted to understand what is the utilization level for the existing plant, and are we doing any debottlenecking, and how should we look at the volume growth for the existing plant, from the existing plant?
Yeah. Now, last year we did a debottlenecking exercise and we increased our capacity on some of our key products by 15%. That's an ongoing process. Utilization of our major products, we have so many plants, So some of our major products are almost 90%, 85 to 90% utilized. But there are some plants where there's some spare capacity and room for better utilization and growth coming out of existing facilities. And then, of course, we have the new plant which is commissioned, which will be commissioned now, where only 25% utilization will be this year. So these are all the areas where there's the upside for growth.
Okay. So what would be the capex for next year, given some deferment in R&D lab, what we are setting up?
Coming year, our capex plan is 180 crores, which includes the new R&D center and then other capex is for new plants. So
one more additional plant, which is included in this 180 crore capex?
Yeah.
So we have already begun the construction work, or it will start maybe in next couple of quarters?
No, it will start. It's at the planning stage, and then we have a few miscellaneous projects, but the major project work will start.
So again, this new plant, we are aiming for the contract CMO business or enterprise business? Both for
enterprise and contract. As I told you, we have to introduce 2 or 3 enterprise sales products as well. So we need to build the facilities for that. There is this investment is a combination of the R&D and these new investments that we need to make.
Okay. Sir, and what I understand is from the existing CMO business, couple of contracts are getting, long-term contracts are getting over in next 1.5 years. So anything on that front of renewal front, or it will be more or less annual kind of contract that will go through?
No, these contracts are, we are in the space where these products are what you call the off-patent proprietary kind of segment. So they don't. We are in certain cases we're the single source. In certain cases we are the second source. We are one of 2 sources. So they just continue. In some cases we don't. It might be a 5-year contract, and then the contract says that it will be automatically renewed every year. So it just goes on like that. So it's like an evergreen kind of project. We haven't come across a project so far that said, okay, this is being terminated now.
Okay. Thank you.
Thank you. The next question is from the line of Amar Maurya from Alpha Accurate Advisor. Please go ahead.
Yeah. Hi, sir. Thanks a lot for the opportunity and congratulations for a good set of margin. Sir, my first question is on the, understanding the rationale behind merger between the Astec Lifesciences and Godrej Agrovet. Because what I understand is that Godrej Agrovet is a company which is diversified into pet foods, palm oil, and then a piece of agrochemical. But if I see pet food and palm oil businesses, which are relatively a low margin business, so I believe the P multiple which we will get for that versus the specialty chemical CDMO kind of a business which is Astec. So, wanted your rationale to understand, what is that we are looking and why we are looking to merge this company into the Godrej Agrovet.
The specialty chemical has a high multiple because it's a fast-growing business. And we feel that Godrej Agrovet will also be a fast-growing business. So we don't think even today, Godrej Agrovet and Astec have much the same multiple. So we don't think that is of concern. And we consider Godrej Agrovet to be a very broad-based agri-business. We are not in pet food. We are in animal feed, which is a very agricultural business. We are in all sectors of agriculture. And we feel that Astec fits in very well with our portfolio.
Well, sure. We will take it probably discuss off the line because I think it is not in the probably in the interest of minority shareholders. Both businesses are completely different. In fact, there are companies which have such a business like Astec. They would love to demerge it and list it as a separate company, whereas we are trying to merge. Because both businesses have a different profile, different return on capital employed, and of course, different strategies to grow the businesses. Anyway, we'll take it, off the line.
Okay, fine. We will think of your suggestions. As I said, we have no plans for the merger right now, and we'll take on board your suggestions.
Okay. And so second question is on the profitability front, like we indicated that, our broad target is about 25% kind of a margin. So on a year-over-year basis, should we see that the profitability on an uptrend from here on?
Yes, our endeavor is always to increase the margins, but as we say, we've been saying that we will definitely keep our EBITDAs above 20%. But as our product mix improves, we can see an incremental improvement in that EBITDA margin. But it's not going to happen very rapidly. It's going to happen slowly.
Okay. Now, why I'm asking this, as we indicated that, the profitability in Q1 and Q2 will be similar to Q4. But what I see here is that normally in a Q1, historically, the margin comes down because of the probably product mix and all. So is that few of the products which we had contracted and which have a higher margin, and that is why we are indicating even in the Q1 and Q2, the margin would be similar to what we had seen in Q4?
Well, that's what I don't want to make any predictions about Q1 because that's a forward-looking statement, but I can just say that we just look at our business as an annualized basis, and we don't look at it as a quarter-on-quarter business because, as I said, I'll let you explain how our business works. That our customers on our CMO business run campaigns. So in a particular year, they might run their campaign in Q2 and then therefore want us to supply in Q1. In some years, they might run their campaign in Q3 and want us to supply in Q2, and so on and so forth. So our quarter-to-quarter results will always be a little skewed this way and that way. So the guidance that you have to take from us is to do with our annual results, which is what we're telling you it will be. So don't go into this quarter-to-quarter granularization.
Okay. Yeah. If you can give me the enterprise business.
Sorry to interrupt, sir. I would request you to rejoin the queue for follow-up questions. Thank you. The next question is from the line of Ashish Thavkar from Motilal Oswal Asset Management. Please go ahead.
Yeah, thanks for the opportunity. So would you like to comment on the new generation triazole fungicides that we are working on?
Yeah, well, we are working on the biggest triazole fungicide, which now is already on the market. I think people know about it. I don't need to spell it out over here. But we plan to bring out the product. The development is completed. We are just working on the regulatory part, and then we need to do the scale-up work and bring it out. So we want to put it onto the market at the end of next financial year.
Yeah. So, obviously, needless to say that we'll be having a better cost control than the other guy who's making it.
No, look, we are the go-to people for triazole fungicides. We know everything about it. We'll be starting right from the basic stages. We understand this chemistry extremely well, so we are confident of having the best cost position in this market.
Yeah, this is very helpful. So on the new R&D facility, obviously we are looking at many spaces like fluorination.
So this is the operator. I would request you to ask 2 questions.
Yeah, this is my second question. I'll just, yeah. Thanks. So on the new R&D lab, obviously among fluorination enzymes and stereoselectives that we want to get into, which is the first chemistry that we'll be putting our hands on?
Well, fluorination will definitely be the first one, and that involves KF chemistry and HF chemistry. And then we will have high pressure chemistry, and then of course we're not so wedded to chemistry as what is required for each product. So we'll be more customer and product led, but we will develop the capability based on what the customers are needing at that specific point of time.
Yeah, this is very helpful. Thank you and all the best.
Thank you. The next question is from the line of Divya Jain from ICICI Mutual Fund. Please go ahead.
Thanks for taking my question, sir. I had more macro-based questions. So if you read the regulations in Europe for trizol, so they're considered like more of environmental concerns, human toxicity issues, and a lot of these players like BASF, Corteva, BASF are withdrawing and coming up with a combination molecules or effective substitutes. So I don't know how one should read about this. Is there a long-term impact for this on the overall industry, and how about the other countries in terms of these regulations?
Well, you're talking about the endocrine disruption concern. The products which have these problems have already been withdrawn. Now the ones that are remaining have a cutoff which is not going to which are going to be passing the safety criterion for these, particularly Europe, which is very particular about this. So the products that we are talking about, all the big guys have gotten this. I mean, BASF has got a new triazole fungicide. Bayer has a new triazole fungicide. Everybody, all the big guys have a new triazole fungicide. So it's not that triazole fungicides as a class are going to go away. It's just that the newer generation ones are going to do better. And so the ones that were really bad have already gone away. And then they are always a very important mixing partner for the new generation of fungicides called LDHIs. So as a mixing partner, they will always have a value. And so we don't see that this segment is going to decline. It's just that we need to keep up with the new chemistries and see that we are in those markets going forward.
So for these new chemistries and the new molecules, okay, so you want to have new registrations, or how is it going to work for you from your perspective? So if you have to work for batteries for the new product, so the existing registrations will work, or it will be a new process altogether?
No, every product needs its own registration. We always develop the whole data pack, then get it registered. That's a normal process.
Okay. Thanks.
Thank you. The last question is from the line of Dhruvam from HDFC Mutual Fund. Please go ahead.
Thank you so much. So in one of your earlier comments, you mentioned that the new herbicide plant will have 50-50 split between CMO and enterprise. So is this 3 years down the line when you have full utilization, or this is just for the first year that you were mentioning?
No. This is for the first year. We're talking about this year. Afterwards, our CMO proportion will increase significantly because as I told you, some of the patented molecule that we're talking about, it's going to take a few years for that to ramp up, right? So as that volume grows, the proportion of CMO will increase significantly.
Got it. And so I understand the enterprise, if I don't understand it wrongly, the enterprise business margins will probably be volatile depending upon RM and the end product pricing. But the CMO will probably be more stable. So, and firstly, is that understanding right? And secondly, is it possible to give some guide on the margin difference between say, the enterprise and the CMO business? I mean, the guide, of course, will depend upon what average do you use for enterprise, but some sense there.
Some sense is that our contract manufacturing business has a gross margin which might be about 5% better than enterprise sales on a blended average basis if you look at it over a period of time. But that's about the only flavor I can give you right now.
All right. That's helpful. And so lastly, you mentioned 180 crores of capex this year, right?
Yeah.
In FY22. So okay. So I mean, it seems our FCF generation will be a bit lower. So we'll be using debt to fund the capex.
A little bit of debt will be required. Yeah. Saurabh, please come in on that.
Yeah, a bit of debt would be required. That's right, sir.
And so any color that you can give for capex for FY23?
But as I said, our debt equity ratio is very comfortable. So
true. Yeah, that I get. I just wanted to check my numbers. And on FY23, any sense on capex? Any initial color? I believe your R&D will come up. So
we haven't firmed it up yet. No, I don't have that number. We've not firmed it up.
No worries. Okay. Thanks a lot, sir.
Thank you.